Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Investors have not had an easy start to the year. In fact, it's been pretty crazy. Equity markets in the United States, Asia and Australia have been hammered in the last month as investors worry about interest rates rising. Adding geopolitical tensions, the ongoing COVID crisis and global inflationary pressures, there's a lot to try and make sense of. Lucky for us, we've got the assistance today of one of the biggest investment managers in the world. Global giant Mercer has almost $400 billion of assets under management and more than $17 trillion under advisement. Rich Nuzum is the president of wealth at Mercer and joins me this morning from New York. Rich, welcome to Fear and Greed.
Thanks, Sean. Great to be here. Thanks for having me.
Talk about crazy markets. What is going on? Volatility. It's amazing, isn't it, at the moment?
It really has been just huge fluctuations day to day and lots of interesting things going on under the surface driving that.
Okay, so let's get into some of those. Is it all about inflation, Fed interest rates? Is that what's driving markets, or is it geopolitical? Where do you come down on all that?
I think inflation and interest rates is the most important fundamental dynamic right now, but it's more the policy response to that and the impact of that on the real economy and discount rates, as opposed to the actual headline inflation numbers at a point in time. There's a Federal Reserve board meeting later this week. The path of actual Fed interest rate increases isn't the big issue. The big issue is the $9 trillion Federal Reserve balance sheet. So just think about that for a second. $9 trillion on the Fed's balance sheet. Central banks didn't used to have large balance sheets. That's 7 times the size of Australian national GDP for the year. That's the amount of money out there that the Fed's holding that it's going to unwind. And whereas market analysts have a good sense of what the Fed might do by way of short-term interest rate hikes, on that balance sheet, the Federal Reserve Chair said, well, we'll figure it out over the next couple of months. Markets have woken up to that and are kind of panicking about the uncertainty associated with how that balance sheet will be unwound.
How is it unwound in real terms? Is it higher interest rates? Is it the ending of quantitative easing? What are they actually doing to try and recoup that?
What they've announced is that they'll stop buying bonds in March in terms of net additions to the balance sheet. So the quantitative easing will come to an end then. But that leaves aside, what are they going to do with the $9 trillion? Are they just going to let that run out as things mature, the money pays back and they don't reinvest it? Are they going to reinvest part of those proceeds? And then there are Fed observers, including former members of the different reserve bodies, that are saying, well, you should actively sell your mortgage-backed securities, your riskier securities, and hold more conservative things. And that uncertainty, the Fed's a major market participant, has been a major market participant. That uncertainty is really roiling markets.
Okay, and so we talk about easy money in the last couple of years. Potentially the next couple of years, it's not quite hard money. I'm not quite sure what the term you use is, Rich, but it's the opposite to easy money potentially.
Definitely, yes. And because, for example, the tech sector is about future earnings growth and not just the direction of the economy, but the revenues, the profits are out there in the future. Long-term interest rates matter a lot. So when we talk about inflation, when we talk about interest rates, for different investors, different definitions of inflation matter, but also long-term interest rates can matter a lot more than short-term interest rates. And the long-term interest rates are where the volatility is and the uncertainty is.
Okay, so let's just move on to the tech sector. It's very early in the December quarter earnings season, but a couple of really notable tech companies have come out and been hammered. Netflix one, it said its subscriber numbers were lower than anticipated. I think its share price dropped 21% or something. That was last week. Peloton's the other one, which has been a crazy ride. That's the home fitness group, Peloton. It came out, it's having problems in its production end and its manufacturing end, and its share price was dumped. People don't like tech stocks at the moment.
Yeah, I think there are bearish dynamics there and then actually bullish dynamics. If you look at the market for non-fungible tokens or cryptocurrency, anything digital is done well, even things that don't necessarily have underlying earnings or a business in the way that Netflix or Peloton does. So the bearish part is with market volatility, the volatility index, the VIX, is trading at a level that we haven't seen since November of 2020. So think about how uncertain things were about not last November, but November year prior about COVID virus and its progress and so on. That's the level of volatility in the market. So tech stocks, where most of the earnings are out in the future and uncertain, they're getting hammered along with all things digital. On the bullish side, there's a lot of optimism that Omicron may be our last major wave, that economies are just going to, with the possible exception of China, that national governments are just going to let the pandemic be endemic going forward. We won't have further lockdowns post-Omicron. We will get used to living with this and whatever vaccinations are required. That's bullish for the underlying economy. But if you're a digital company and you've benefited from having people locked down, if you're Peloton and you've benefited from people having a lot of time to work out at home, that really impacts your future's earnings growth. So two sets of things impacting digital, one that's bearish for the entire markets, which is higher volatility, higher interest rates. The other, which is actually bullish, which is a resumption in normal, in real life economic activity at the expense of things digital, whether it's personal life or work life.
Okay, I'll get to cryptos in a moment, but that what you're talking about there, that must be good then for cyclical stocks, and we've seen a bit of that. And back to the earnings season, sort of very early on, some of the, I think some of the train companies in that actually came out with pretty good results. Puma was another one. Do you expect that rotation into cyclical stocks to continue? I mean, is that happening? Will it continue? How do you see that?
That one's tough. And I think to have a real strong view on that, you need to have a view on the virus. And a lot of people have lost a lot of money trying to outguess the virus over the last couple of years.
Yep, fair enough. So that's a bit of a wait and see. We need more time and evidence before we make a judgment on that one.
I think so. And my advice to investors would be to diversify rather than play that short-term play. Do both. Digitalization is going to continue. Globalization is going to continue. One of the benefits of a full employment economy, it's a great time to be a worker. It's a great time to be an employee. We've got wage growth in most of the world for the first time in our working lifetimes. We've got employees being able to say to their employer, hey, I'd prefer to work remotely. And if you can't accommodate that, that's fine. I'll find a job that will. Labor actually has some bargaining power now. Now, if you're providing capital to the stock market, that's inflationary pressure, that's tough on your earnings and so on. But it's a great time to be a worker. And with that, the political opposition to globalization, to free trade, to digitalization has receded a bit. The chance that populist governments get elected to protect in the short term workers from those competitive pressures has receded a bit. Companies are able to digitalize. Globalization is able to proceed. So I think digitalization is going to continue to happen long term. At the same time, we've got a lot of income, cash on balance sheets of households that people are waiting to spend. People are eager to travel. They're eager to spend in the real economy. We saw it over the Christmas holidays with spending. And so our advice to clients is to diversify, not put all your eggs in one basket, but play both.
Stay with me, Rich. We'll be back in a minute. I'm speaking to Rich Nuzum, President of Wealth at Mercer. Okay, you mentioned cryptocurrencies and NFTs, non-fungible tokens, earlier on. They certainly have a lot. I'm not sure about NFTs so much, but cryptocurrencies have had a rough start to the year. How do you see those particular assets performing?
I'm a long-term bear on crypto, and I think to me, crypto falls somewhere between gold and NFTs. Gold is an asset that many market participants would point to as a hedge against creative monetary policy, as an inflation hedge, as a store of real value over time. And even if they don't expect gold prices to go up in real terms over the long term, they'll use it in their portfolios to hedge inflationary risk. Crypto has served the same purpose for some investors, and that sort of speculative hedging purpose can be legitimate. But then we have NFTs, which have no intrinsic value. Same as crypto, gold has an intrinsic value. Gold has industrial uses. Gold has actual uses that create a floor on gold prices. Crypto doesn't. And then NFTs gives us a proxy. If you believe that crypto has intrinsic value, that there's something to crypto beyond, say, the gold corollary, well, then explain why it's so correlated with NFTs, which don't have intrinsic value, but have fluctuated in the same space. It's been interesting the last few weeks to see crypto off and to see many market analysts saying, well, all things digital are getting hammered, so of course crypto will be hammered. That wasn't the thesis that we heard from crypto enthusiasts last year. Crypto was supposed to provide diversification.
Yep.
The other big challenge with crypto is I do think that many nation states will move to have a digital currency, but it's going to be sponsored and regulated by their central bank. Central banks and national governments in general don't like competition.
Yep.
They control the armed forces, they control local taxation. There's certain natural monopolies that accrue to a nation state. And one of them is their currency. And we've already seen the Chinese government crack down on crypto. Unfortunately, crypto is vulnerable to regulatory disruption. And the last issue is crypto is horribly carbon emitting. Now there's advocates for proof of stake instead of proof of work. And if that transformation happens, crypto could go from being carbon emitting to at least neutral. But that isn't where we've been. The crypto sector, crypto mining has been worse than personal vehicles, automobiles as a source of emissions, just horrible from an ESG standpoint. So I think it's hard to be bullish on crypto, honestly, unless you have a commercial interest in it.
Okay, just quickly, Rich, the themes of the next 12 months or 2 years or so. Let's start with the geopolitical tension. I mean, it's sort of hourly news in terms of what's happening around the Ukraine area with US, NATO, etc. How big an issue will geopolitics be in the short to medium term?
I think it will remain a huge issue, but with China being a lot more important than Russia and the Ukraine, fundamentally and for the long term. And also with things like the progress of green policy or climate change related policy in Europe being more important fundamentally. And I say that because the Russian economy, Russia's an important player, especially in the energy markets. I really hope and pray that Vladimir Putin's not about to make a horrible miscalculation and invade the Ukraine, because I think that would be disastrous for Russia, not just in terms of economic sanctions, but in terms of Russian influence on Europe, in terms of Russian participation in the global economy, huge miscalculation. But if it happens, the Russian economy is only 1.5 trillion of an $80 trillion global economy. There's other energy producers. And Ukraine, I hesitate to discount the human cost of an invasion, but it's a $165 billion economy. So it's not material to the global economy except for impact on sentiment. But things like how China participates in the world order. And we are in a multipolar world, and China is its own pole. And so China is going to have a seat at the table determining how trade works and how intellectual property works. And it's an important economic motive. It's an important source of innovation. That's going to matter a lot more for earnings of most of our clients' investments over time than the specific issue around Russia and Ukraine, although at the moment that is roiling markets.
Just quickly on that, because China obviously is a very, very important partner of Australia, particularly on the commodity side. Do you think that the central bank will continue cutting rates, will continue pushing manufacturing, which should have positive flow-on effects for the Australian commodities, things like iron ore, coal, etc.?
I think they will, but the biggest source of uncertainty right now that we see for China is, do they maintain the zero COVID policy, which would be a deviation from what we're seeing in the UK or US or many other economies globally. It's worked relatively well for China so far, but if we see China try to maintain a zero COVID policy amidst Omicron, the concern is massive global supply chain disruptions, possibly worse than we've seen so far because of shutdowns in Chinese domestic production. One other issue with China is that it's hard to play the Chinese onshore A-share market. We think it makes a lot of sense to play in that market, even though the global index providers haven't fully included it in their indices, because China is such a large economy, but also because the Chinese economy is uncorrelated with the rest of the world. And so China actually cutting interest rates and stimulating economic growth, they'll need to do more of that if all else being equal, if they maintain the zero COVID policy and try to avoid or mitigate the spread of Omicron. If they have production disruptions because of that, they'll need to do more by way of domestic stimulus. At the same time as the rest of the world, we talked about the Fed earlier, is moving to more hawkish monetary policy. But that lack of correlation, if you're a global investor, you'd want to play both. You'd want to be in China, where there's potentially going to be expansionary monetary policy. You'd want to be in the US, where there's potentially contractionary policy, because you're trying to get that diversification in your return drivers.
Rich, thank you for talking to Fear and Greed.
Okay, thank you.
That was Rich Nuzum, President of Wealth at Mercer. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.